Something strange just happened. Gold dropped. Silver fell harder. And the explanation everyone was given sounded thin. Markets adjusted, profit-taking, rates changed. But here's the problem. Those explanations don't match the violence of the move. This wasn't a gentle repricing. It wasn't uncertainty. It wasn't fear rippling organically through the market. It was sudden, mechanical, and oddly synchronized, which usually means only one thing. The system did exactly what it was designed to do. And today, we're going to walk through that system slowly, simply, and honestly to understand why gold and silver didn't just fall, they were reset. Let's start with why this matters right now. Because this crash didn't happen in a vacuum. It happened at a moment when global debt is rolling over at record levels, when governments are refinancing old promises with new ones, when central banks are trying to look confident while quietly losing room to maneuver. In that environment, gold and silver are not just metals, they're thermometers. They measure trust. And when the temperature rises too fast, the system reacts, not emotionally, structurally. Now, let's clear up a misconception right away. Gold and silver prices do not primarily move because people suddenly want necklaces or coins or bars. That world still exists, but it's not the one that sets price. Price is set in paper markets, futures contracts, options, swaps, synthetic exposure on top of synthetic exposure. Think of it like this. Imagine a single house. Now imagine 100 people each holding a contract that says they have the right to that house. Some plan to flip it. Some plan to hedge. Most never intend to visit it. That's the gold and silver market. Real metal exists, but it's buried under claims, and those claims are leveraged heavily. Which brings us to the first invisible force, leverage. Leverage means controlling a large position with a small amount of money. It's powerful when prices move your way, and brutal when they don't. Gold futures allow traders to control enormous exposure with very little cash. Silver futures are even worse. That's why silver always looks unstable. It's not emotional. It's fragile by design. Now, picture what happens when prices rise steadily. Momentum traders enter. Funds add exposure. Algorithms detect trend strength. Positions grow. Open interest increases. The system allows it until it doesn't. Because leverage always comes with rules, margin requirements. These are not suggestions. They are automatic. When volatility rises, margins rise. When margins rise, traders must add cash. If they can't, positions are liquidated instantly. No negotiation, no opinions, just math. This is where the crash begins. Gold had been climbing quietly. Silver started waking up, not exploding, just enough to get noticed. And that's important, because slow, steady increases are tolerated. Fast moves attract attention. Not public attention, system attention. Then a subtle shift happened. Interest rate expectations nudged upward. The dollar strengthened slightly. Bond yields ticked higher. Not dramatically, but enough. Enough to justify tightening financial conditions. And once that process starts, it feeds itself. Margin requirements rise. Funds sell to raise cash. Selling pushes prices down. Lower prices trigger stops. Stops create more selling. Silver breaks first. It always does. Because silver is thinner,
more speculative, and more crowded. Once silver snaps, it sends a signal, not to humans, to machines. Algorithms flip from accumulation to liquidation. Liquidity vanishes, prices gap. Gold holds briefly, then follows. This is where most people misread the situation. They think the selling means something changed, but forced selling is not information. It's a consequence. The system isn't saying gold is worthless. It's saying positions are too large. This is a crucial distinction because nothing fundamental changed. Debt didn't disappear. Deficits didn't shrink. Currencies didn't dilute structurally. Only positioning changed. And positioning resets are violent by nature. Now let's talk about the phrase people argue over. On purpose. Did someone manually push a button labeled crash metals? No. Modern control doesn't work like that. Power today lives in frameworks. If you build a system with extreme leverage, thin liquidity, and automatic enforcement, outcomes become predictable. You don't need intent, you need architecture. And the architecture of gold and silver markets is built to prevent disorderly signals. Because rising gold isn't just a trade, it's a message. It suggests currency stress. It suggests declining confidence. It suggests that something underneath the system is weakening. That makes policymakers uncomfortable. Not because gold threatens them directly, but because what gold represents does. Gold rising slowly is tolerated. Gold moving fast is destabilizing. So when prices accelerate, the system tightens. Liquidity shrinks, rules harden, weak hands are removed. Not maliciously, procedurally. Now let's widen the lens. Who actually loses in these events? Not central banks, not governments, not institutions that understand margin mechanics. It's late entrants, retail traders, people who bought the story without understanding the structure. People who thought they owned safety, but actually rented exposure. This is where a critical difference matters. Owning metal is not the same as trading metal. One is boring, illiquid, unexciting. The other is thrilling, fast, and unforgiving. The system punishes excitement, quietly. Now, let's address the irony. Gold and silver are marketed as protection from instability. Yet, the way we trade them creates instability. The more fear enters the system, the more leverage piles into metal trades, and the more fragile the market becomes. It's absurd. The asset meant to hedge systemic risk becomes a source of it. Silver suffers the worst. It's too small to absorb large flows, too symbolic to ignore, too volatile to trust. That's why silver's chart looks like chaos, spikes, crashes, long periods of disappointment. Not because the thesis is wrong, but because timing inside a leveraged system is brutal. Now contrast hype with reality. Hype says, this proves manipulation, metals will explode. Reality says, this proves management, metals will only rise when allowed. Those are not the same outcome. This crash didn't end the story. It cleared the stage. Excess leverage flushed, weak positions removed, volatility reset, pressure released. Temporarily. Because the underlying math hasn't changed. Governments still roll debt. Central banks still balance credibility against solvency. Currencies still dilute quietly. Gold and silver didn't fail. They were restrained. And that restraint only works for so long. Here's the uncomfortable question. If metals can be reset through leverage mechanics, what happens when physical demand overwhelms paper control? What happens when confidence erodes faster than positions can be cleared? What happens when pressure builds faster than the system can release it with another crash? Because eventually, systems designed for control encounter limits. And when that happens, moves stop looking mechanical. They start looking chaotic. So the next time you see gold or silver drop suddenly and hear the word panic, pause. Ask who was forced to sell. Ask who needed liquidity. Ask what signal got too loud. Because in modern finance, the most important actions are invisible. They look boring. They look technical. They look procedural. And the most powerful decisions aren't announced. They're embedded. Quietly. Relentlessly. On purpose. And if that's true, the real question isn't why gold and silver crashed.